Welcome, everybody. This is Geoff Dohrmann, founder and CEO of Institutional Real Estate Inc., and I'm excited to launch this new series in collaboration with Alliance Global Advisors. We're calling it the NextGen Capital Markets Conversation. This is the second in our series. This podcast is designed to explore the strategies and market dynamics shaping the future of real asset investing, from product design, platform evolution, and private wealth access. Each quarter, we'll sit down with members of the Alliance team, different people each time, to unpack the key issues and share practical takeaways for managers looking to grow and evolve. We're going to explain in a few minutes who Alliance Global Advisors are and why it's important, and actually pretty cool that they're sharing this kind of information with all of you. I should note that Alliance Global Advisors, among other services, advises investment managers on how to go about navigating the capital sourcing environment, from helping them decide which channels to access to what kinds of products to structure, the different sources of capital, as well as helping them understand what to expect as they pursue these initiatives. Here at Institutional Real Estate Inc., we publish, among other things, Real Asset Advisor, a monthly magazine published 11 times a year that's edited to meet the information needs of more than 50,000 members of the private wealth advisory community, including 5,000 investment program decision makers. These are the professionals who are responsible for approving investment programs for recommendation to their clients. And to the best of our knowledge, it's the only publication that we know that offers advisors the objective, independent, credible, non-conflicted information on investing in the real asset classes that they told us they really want and need, filling a mission-critical gap in the marketplace. That publication is really designed, as well as to inform the advisory community, it's also designed to help investment managers who want to reach that marketplace develop a stronger brand identity in the markets while differentiating their offerings from those of their competitors and getting better connected with the people who are in a position to move the needle on their capital fundraising efforts. Our mission, in short, is to help these companies win the capital fundraising battle in the market by helping them accelerate the relationship building and trust building process. Joining me today from Alliance Global Advisors are Jason Puchmeyer and Kurt Edwards, both of whom are vice presidents of partner engagement at Alliance. Jason and Kurt both work closely with investment managers to help them navigate capital markets, refine their messaging, and position themselves for long-term success. Jason brings years of experience as an institutional consultant, having spent 12 years at the Townsend Group and 5 years as a real estate developer. Kurt comes to Alliance after 12 years at UBS, working across the U.S. real asset platform in various capacities, including head of taxable real assets and a member of the CIO team for U.S. real estate. Jason, before we dive into today's topic, can you start by giving our listeners a quick overview of Alliance and the work that your team does?
Yes, thanks, Jeff. So Alliance Global Advisors is a women-owned consulting firm that partners exclusively with real asset investment managers. We help our clients grow, institutionalize, and compete more effectively for capital. We act primarily as an extension of staff, bringing a perspective that blends market insight with hands-on execution. Since launching in 2020, we've advised managers representing more than $900 billion in AUM, and we continue to evolve alongside the industry, especially as investor expectations shift and sources of capital become increasingly harder to capture.
Yeah, and it has been hard to raise capital in this last few years in market environment. But despite the difficulty, since 2020, our IREIQ database tracked more than $875 billion in capital raised by funds, with more than 1,116 funds in the market right now seeking to raise more than $130 billion. And that's just institutional capital. Our friends at Blue Vault, one of our strategic partners, could provide data on how much managers are trying to raise right now in the retail investor space, which is considerable.
That's great. And that's where today's topic comes in, thinking beyond traditional fund structures and exploring alternative ways to form partnerships and source capital. Even though this space has been growing with those numbers you just mentioned, there are still some middle market or smaller managers still struggling to attract capital. It's no secret that today's capital raising environment is challenging and highly competitive. Our clients and other investment managers continually ask us ways in which they can navigate this current market and how they can launch a vehicle and have a successful fundraise. In addition, many of our clients have approached us expressing their desire to enter either the open-end or / evergreen fund business and launch a perpetual life vehicle. We all know the pros and cons to that, creating enterprise value, stream of fee income. We also know this market is very saturated with over 80 plus open-end funds in the market today. So this kind of made us start thinking outside the box about how investment managers, in particular operators that are typically vertically integrated, can source capital outside a traditional fund setting. Some emerging operators go from GP funds or one-off deal syndications with joint venture partners to wanting to launch a full-on discretionary LP fund, and in some cases an open-ended fund, which can require a heavy platform investment in resources and infrastructure. So we've helped our clients in this phase of growth understand that there is a large bucket of capital that they may have skipped over, which is GP to GP programmatic relationships.
Yeah, let me interject one thing, Kurt, before you go. IREIQ shows over 258 US-focused open-ended funds. And again, those are all institutional open-ended funds. They're not focusing on raising capital from the retail market, where the predominant preferred type of vehicle is an open-ended structure. Kurt, go ahead. Sorry.
Yeah, no worries, Jeff. And I'm glad you mentioned that. I mean, as Jason mentioned, it's really an exploding area in our, not really just in our asset class, but across private wealth as well, as you're aware. But maybe it's helpful as well before going further, just to define some terms, because maybe some of the viewers of this video cast might not be sophisticated or have a lot of experience in this realm of which we work in. So I think the terms that we're going to be mostly using today within this video cast are two, which is allocator and operator. So in general, we use the word allocator to describe investment managers who specialize in making capital allocations and aren't typically vertically integrated. So what that means is that they might not typically have boots on the ground resources from property management or construction or development. And oftentimes they need to hire third-party firms to manage these properties. Conversely, the second term is operators. We'll be using that a lot as well, where these firms are really the firms that allocators might use that have scale in the form of headcount in metros that they operate, which again could include, for operators, property management and development. So think of it as operators tend to have deep but narrow expertise, while allocators have a wide view of the national market, but need to excel in selecting the right on-the-ground operator. And the reality is that many of the example of firms are somewhere in the gray area. It could be a hybrid approach, but we want to try to keep it simple for today's discussion to really focus on their creativity around structures and alignment of partnerships between these two entities.
Okay, and now Jason, you mentioned that this is really crowded, this whole field of open-ended evergreen funds. Seems like there's a lot of competition in the market right now. Is that level of competition also influencing the need for creative structures from the allocator standpoint, do you think?
Yes, absolutely. And it's really coming from two angles, fee compression and deal sourcing. So if you look at the NCREIF Odyssey Index, which is pretty predominantly in the institutional space, about 90% of LPs use that as their benchmark, right? So it's a fairly good, not perfect proxy for fund fees over time. So if you look at the gross to net spread, you'll see a trend of about 110 to 120 basis points back in the 90s, early 2000s, down to about 70 to 90 basis points over the past 5 years. On the sourcing side, managers are forced to be more creative than just using kind of the same transaction brokers across the nation that everyone else has access to. So you'll see more deal sourcing done through partners where there's some level of exclusivity or preferential treatment in accessing an acquisition or development pipeline.
Yeah, and Jason, I might add one more if you don't mind. There's really also a third angle that's been discussed a good amount lately in the network that we all run in private real estate, and that's operational alpha and the need to generate that and more of it, given that we can't rely on cap rate compression. At least that's what we're forecasting for the next 5 years. So, there needs to be a clear messaging on how the allocator investment manager intends to be more actively managing assets and adding value. So that's either building buying or even partnering with sector specialists, which is the typical route that we'll be talking about.
That's really helpful insights. Thanks. But from an allocator standpoint, establishing a programmatic partnership may give them the ability to expand into sectors with specialists, and the operator specialists can leverage their partners' capital raising and management mechanism. Are there any other benefits from this marriage
Yeah, so
between
I think
asset managers and transactions?
Yeah, so I think from this aspect, right, the partnership can create synergies across both platforms, utilizing the expertise from each partner. From a pure kind of transactions point of view, transactions can do kind of a lighter underwriting once the relationship is established, and the operator due diligence process is assessed for quality, then allowing those same resources to be used to dig deeper into new markets or sectors. So really freeing up the time with that lighter transaction oversight. In terms of asset management, that can mean more ability to kind of focus on accretion or dilution based on forecasted values. So really, in the end, it's getting a lighter lift from these teams so they can focus on more deeper knowledge of the markets and the transactions.
Yeah, and Jason, I think another point too to what you just said when you're saying allowing them to focus on other markets, many times that means they're using data and running potentially different forecasting models across those markets or even assets in reality. So another huge benefit from this marriage, we'll call it, Jeff, is that it could give access to a higher integrity and more fidelity of data, right? So if you think about it from an allocator standpoint, if they don't have property management at the property, giving them all of this information of rent, vacancy, trends around lease conversions, for instance, that's not something an allocator might have access to. And so being able to partner with an operator or like a property specialist creates a potential where they can now get access to that data and do more with that data. And I think in this realm of what we're hearing today, where data is gold, I think we're going to be able to see more ability to create alpha through use of that data, which is super important going forward.
You mentioned specialists and generalists. How is the market viewing? What's the preference here versus
Yeah,
specialist or generalist?
yeah. So over the years, right, I think back, maybe a decade or two ago, generalist or allocator was kind of the way to go. Just LPs would give money to an allocator, they diversify a portfolio. There was two levels of fees there. Really over the last 5 to 10 years, the operator kind of model has come to fruition, and many LPs prefer the operator model. So many of these allocators source a lot of their deals from their pipeline of brokers. They're covering basic market opportunities, but really partnering with a sector specialist can provide access to almost a proprietary pipeline of deals and attract alternative sources of capital. This is especially true in kind of the emerging alternative property types, which we've all been hearing about over the last 5 years, where investor interest continues to grow in the data centers and cold storage. So really having that specialist on the ground, knowing that market in and out, has been very beneficial.
So how else can a partnership with a specialist diversify or enable more opportunities in sourcing?
Sure. So this type of partnership can entice co-investment opportunities for allocator fund investors, which this in turn can give the allocator more reasons to interact with its largest investors, creating that synergy between the two. It's also a scenario where having a specialist partnership can diversify sourcing opportunities, kind of as we discussed before.
So how can these creative arrangements and partnerships be created? Be started, begin. Is there some creativity needed here as well?
Yes, Jeff, as I think you mentioned, and even Jason as well, at times, especially in the open-end fund world at this point, liquidity is pretty scarce. So I think starting or creating a programmatic venture is somewhat scary for some big allocators at this point, where some of these specialist operators will say, look, I have a pipeline, and if you're willing to commit 500 million, that's great. That's not typically what can start a relationship today with some open-end funds. So we're even getting a little bit more creative there. If you think about what open-end funds have as embedded or intrinsic value, that could be of value to the operator, is current assets, right? So for instance, if you have office buildings that are underperforming, or if you have hotels, or if you have self-storage or apartment complexes. Let's say some of these open-end funds could have pretty darn near close 50 to almost 100 apartment complexes, and some of those might be underperforming. And if they're wholly owned, it's a low-hanging fruit for the allocator to say, well, let me take these underperforming assets, work with a specialist that might overlap in that same strategy or that geographic focus, and see if they're willing to re-underwrite those assets for the potential for a takeover program. And so what that does then for the operator is it might not be new capital, but it's certainly new revenue for them as far as it relates to property management and potentially even asset management fees. So that's another element that we're seeing that could jumpstart these types of programmatic relationships, and really allows to jumpstart the relationship with allocators and provide the chance to prove out their expertise and leading potentially to then in the future additional capital allocations.
So interesting. How do you think these creative capital and vehicle structures are going to create opportunities in the future for operators and allocators or other capital providers?
Yeah, sure. And Kurt touched on it just now with kind of future allocations, right? So these can provide either full integration within the allocator fund or an allocator's balance sheet. They can also provide an incentive and opportunity to provide co-GP capital into new products. And from the multi-manager side, they can support product launches, allowing the manager to kind of build a track record with direct capabilities, then launch indirect capabilities. We saw a lot, we hear from a lot of kind of emerging managers, right? They want to go out and raise a fund. Track record is minimal. They don't have a fund track record. One of the number one things an LP looks or a consultant looks at is track record. How have you performed? How have you executed based on the strategy you want to provide? So all of this partnership can provide kind of all those benefits for both the operator and the allocator.
So interesting. Creating optionality, not just related to deal sourcing, but also co-development products. Is that what you're suggesting here?
Yeah, so Jason hit on this a little bit with for any groups that are allocators that also have a multi-manager capability. This is kind of an inherent option, if you will, for allocators, where if you create a program with an operator or specialist, have, for instance, a takeover portfolio, that could start a track record, almost like a special purpose vehicle per se. And then what that allows is two things. One, at the present, a capital event, right? If there was a takeover program, then taking wholly owned properties from the allocator, having the operator buy into those creates a capital event and potentially some liquidity for the allocator's open-end fund. Because typical JVs could be 95-5 or 90-10. So that 10% or 5% is the GP equity that the operator is bringing to the allocator at times. And then in the future, the optionality is, let's say the track record is going well, that then becomes a potential jump off point where those assets could be seed assets for an entirely new product. So in the example that I might use with, let's say, office or self-storage or multifamily, if there were takeover assets there, then there is a possibility that you use those assets to even form either another open-end fund into the future, or it becomes a building block that then you can use either with club venture types of formats or other like sovereign wealth fund formats that you might bring them in and they could opt into any type of programmatic venture within that special purpose vehicle. So hopefully what that tells you is, or gives you some insight on, is that establishing these relationships, while it might take a good amount of time and thoughtfulness at first, ultimately gives you more options as a manager, especially as an allocator, that your main business is to create fund products, and that's your main revenue is fee revenue from those fund products.
Yeah, you guys know that I always sign off on my editorials by saying it's important to be careful. So what are some areas where market participants really need to be careful, where they need to be aware of? Any key considerations or warnings they need to keep in mind when they're thinking about these issues?
Yes. Now, look, I think everyone in the industry would say date before you marry, right? So So that's not lost on us here as well. And there's certain ways you can do that. As I mentioned before, like the takeover strategies, some people do it, or some managers do it one by one deals. But in the end, when we've spoken to a lot of allocators, Jeff, and what they're looking for with some of these operators, it's really the right cultural fit, right? To ensure that they're eye to eye and they are aligned with the senior management at the operating partner level. And so that means that they need to find the right fit and the right partner. And so doing that means that from an operator standpoint, who's trying to create that partnership with an allocator, finding the right people at the allocator, because it could be the transactions analyst as an operator that you run into, where they're looking at what are the deals that we need to fulfill our exposure for the year for an open-end fund, rather than, by the way, if we take on this deal, who comes with this operator, can we expand that operator relationship to then feed multiple vehicles? Or are there opportunities for us to leverage this deal or multiple deals to ensure that we're better aligned with that operator going forward, and that maybe we can get more exclusivity or preferential treatment in deal sourcing? So who the decision maker is from a strategic level is very important to find at both of these spots. So in the operator and at the allocator. And then I would say building buy-in capital for a program that could take more time than pursuing deal by deal investments. So that's where I mentioned the takeover assets are really helpful. That kind of gets your foot in the door as an operator before you even take over the assets. Maybe you're re-underwriting them, and that's where the allocator can get a sense of, are you conservative? Is the operator aggressive or not? Do I agree with how they underwrite in their business strategy? Do I believe they can execute? That starts to give the allocator a good sense of who this potential partner is.
Yeah, I think Mac McCorder, who runs our Institute for Real Estate Operating Companies, likes to encourage our members to really focus on fundraising as an ongoing activity, not just when you need a deal, because the best time to raise money is when you don't need it.
Yeah.
How does an operator or investment manager seeking a creative capital or vehicle structure and long-term relationship begin? How do you get started?
Yeah, so that's a great question. And so really, first and foremost, you need a very kind of clear thesis to be concrete for an allocator or other capital provider to really justify that additional layer of fees. So, you know, an additional asset management fee, et cetera. There needs to be a clear story that they can successfully market to the end investor. You know, creating kind of a foothold for future strategic opportunities is typically a good way to orient the short-term layering of fees if it comes up, and for long-term gains. Really, the allocator, as Kurt mentioned, they're going to push for exclusivity, which can kind of be difficult for operators, right? They're trying to expand their capital base and, you know, attract as much capital as they can. So to be exclusive with just one allocator could be problematic. But this is where kind of fee arrangement can really be negotiated in this space. And I would just add, you know, as Kurt mentioned, we've talked to a lot of allocators in this space over the past probably 6 to 12 months. And really that hang up of, you know, date before you marry, really doing kind of almost a takeover asset or a deal by deal at first can lead to endless opportunities for that operator. So it's not just an allocator giving a slug of 200 million to an operator with a limited track record. It's really, it's long-term relationship building where that needs to happen.
You guys seem to have a lot of knowledge about this particular area. Of course, that's why we're talking. But you know, how do you really help investment managers? How do you get engaged with them? How do you help them navigate this space and figure out all these issues? Sounds like there's a lot of issues here that need to be determined, and they need to make the right decisions and not, you know, stumble across the marketplace and screw things up in the process.
Mm-hmm. Sure. Yeah. And at Alliance, we're here to help operators and investment managers kind of navigate this capital raising environment, right? We recognize that there's a lot of investment managers who are at a pivotal stage in their growth, kind of that inflection point. And, you know, our proven suite of services is specifically designed to empower these groups and elevate them. So it's not really just about a product or capital. It's about building long-term relationships, trust, and credibility that provide operating partners the ability to scale their platform in a meaningful way.
Terrific. Well, listen, I hope the people that are tuning in agree with me. It's been a pretty interesting, thought-provoking conversation. A lot of issues here to think about. Before we wrap, any final thoughts you two would like to share? And for managers who are at the inflection point in their business who just want to learn more, what's the best way for them to connect with you guys?
Sure. Thanks, Jeff. This has been a great conversation. Really, the mission of Alliance Global Advisors is to, as I mentioned, expedite the growth of real asset investment managers through empowerment and the elevation of best practice. Our team has extensive experience working as prior consultants, capital markets professionals, investors, and investment managers, uniquely positions us in the market to advise them on elevating best practices and meet the needs of the LP community. At any time, if you want to learn more, we're always open to phone calls. You can either connect with either Kurt and I or anybody on our team. You can go to our website, alliance-globaladvisors.com. We're always happy to have the conversation and look and see where that may go.
Or you can reach out to me and I'll refer you in. Alliance is strategic partners of ours, and we do a lot to help support each other. So everybody, thanks for tuning in. We do these every quarter. So next quarter, we'll be visiting again with a different group of people from Alliance Global Advisors, focusing on another area. Hopefully that continues to be a hot topic for everybody that's tuning in. Again, thanks for tuning in today. Take care. Oh, and happy holidays, everybody.